welcome to the Monday Futures Market Outlook for August 29th, 2011. This is Patrick Serezna. For those of you that have not had the opportunity to try out the eminisource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades. We plot an 80-week moving average on there. Does a good job to depict the bull and bear market cycles we've gone through. Last time we bullishly crossed this was back in 2009. And now for the last 2 weeks, we've now traded below that 80-week moving average. Does that now indicate that we're in a new bear market? Well, let's look at the daily charts and start to look at what is some of the bigger picture signs. Just to make a few key intermarket observations, the last 2 weeks have dynamically changed the landscape of the market. The S&P 500, which is now below that 80-week moving average, is signaling a potential for a new bear market. One of the interesting things is the US dollar continues to be relatively range bound, and it certainly has been non-committal in the first stages of this. What will truly drive a new bear market would be money coming into the US dollar with in the fears of a global recession. So we'll be watching and observing that US dollar very carefully, because over the next 2, 3, 4 months, if we do see those bottoms come in on the US dollar and very dramatic, strong reversals in the US dollar, that would be a bad omen for the stock market. The 30-year Treasury bond was just shy of its 2008 all-time high, and we're continuing to see a flattening of the yield curve, which again continues to support a recessionary environment. We're going to be watching where and how deep consolidation goes. We'll look at the chart here briefly. And the last thing, even if there is a longer-term new trend in place, all these markets have made extreme moves. Those treasury bonds made extreme moves. Commodities made extreme moves. Gold has made extreme moves. And the stock market certainly has made an extreme move on the downside. All of them are ripe for retracements. It certainly would not be out of question for us to even spend a month or more just trading in kind of a sideways range, as the market will need brand new economic data points in order to make the next big catalyst move. So we're even though we're looking at these bigger picture trends, recognize the next few weeks very well could be far more sideways than anything. When you take a closer look at that S&P 500, it went for a retest to the previous low, we call a key bottom retest, and subsequently has been rallying. At this stage, we're very highly suspect that this S&P 500 is forming a zigzag wedge, which would entail that it first rallies a little bit higher. At minimum, it would come for a retest of the previous highs around the 1206 area, more than likely a test into the 1215, maybe even the 1240, 1250 area on the upside are all warranted as the S&P 500 strengthens. This would certainly allow a lot of traders to get drawn back into the market as they feel a buying opportunity is there, and they need to be buying these markets, which would subsequently sometime in September turn around and begin another sell cycle. This is most likely the course of action, and the one we think is the most likely to occur. So really the key thing is, as we rally into these overhead resistance levels, it would be an opportunity to reduce exposure to the markets and potentially even enter in some short positions to make some money on the downside. Next year, when we take a look at that US dollar index, the US dollar remains distinctly in a sideways range-bound market. We continue to trade down toward the 73, 73.50 area. If the euro makes a bold move up towards 148, 149 on the upside, we may even see the dollar index very temporarily break down towards the 71, 72 area, but doesn't necessarily have to, depending on how all the other major currency inputs are. Overall, we anticipate the US dollar to be trading in this sideways channel for even a couple months, but eventually, if there's indications that the markets are going into a global recession and there's broader international risk on a global scale, the U.S. dollar will become the safe haven, and we would see bottoms come in on the U.S. dollar, and a very robust short squeeze begin at some point. It doesn't necessarily have to come off of the data points of the next few days. We're going to again be watching where and how low the dollar index consolidates, but we do believe that the dollar will represent a buying opportunity at some juncture over the next month or two. And if we ever did see that US dollar short squeeze on the upside, particularly above that 76 level where the overhead focal points are, it would certainly be the one of the catalysts that will drive another wave of corrections in commodity prices and subsequently drive the stock market down to still yet a lower point at some stage later this year. So that we'll be watching that dollar index very carefully. Next year, when we take a look at copper futures, copper has really been in a very big range between this 380 to 460 level. Overall, right now, that sell-off has tested that support line that came in from the May lows. Really, at this stage, that as well, it looks to be just a flagging formation, and we really do not anticipate copper to be able to make too much of a run above 420, 430 on the upside. The short-term move is still higher, so the next week could still see higher copper prices, but overall we remain skeptical about the sustainability of a rally. We would have to obviously rethink that strategy above the 430 level, but right now what we're doing is we're looking at copper moving higher, but with only a very limited upside, and probably in a couple weeks we could see copper roll over again. Next year, I want to take a look at gold futures, and we were looking for gold to top out somewhere in the 1900 to 2000 area on the upside and have a short-term blow-off top. Gold sold off that high, basically $200 an ounce in a very rapid fashion, but has already found its way back above 1800. We're now going to probably experience some whipsaw price action as gold probably is going to try to bang out some sort of a short-term trading top, which means we should have a number of retests into upper zones and very strong, robust sell-offs that subsequently follow in its overall formation. In the bigger picture, we don't necessarily believe that this will be a major top in gold, but rather a level from which gold will do a consolidation and probably flagging formations. If we had any robust US dollar rally come in over the next few months, it would certainly serve to put gold into a sideways trading pattern for many months up at these higher levels. In the bigger picture, a lot of gold bulls would be targeting levels up in the 3,000, 2,500 area on gold, but I think it's very unlikely that we see, or at least it's not, I don't favor the scenario that gold sees those levels this year. More than likely, after a couple solid retests, maybe even a move up to 2,000, we should probably see an extended period of even 3-4 months trading sideways before the window opens for a move up to those higher levels. Next year, we'll take a look at crude oil, and though crude oil has been more in a downtrend than a sideways trend like copper, the flagging formation should behave very similarly. Overall, on the short term, crude oil may strengthen even up towards the 90-92 area, creating this little kind of wedging formation higher. But we're skeptical about the sustainability of any rally beyond maybe $5 on the upside of crude oil. Once that rally ensues, a short position into crude oil will become a pretty good risk-reward proposition, though no certainty in it. But it would certainly represent a very good risk-reward proposition. So really into strength in crude oil, we're going to be looking at lightening up on any positions in not only oil stocks, but also in any long short-term swing trades higher. Finally, when we take a look at that 30-year Treasury bond, you can see the overhead resistance that we hit up on the 140, 142 area. Really, at this stage, we should probably see some retesting of those zones as Treasury bonds hit some short-term highs, and we'll probably do some backfilling. I don't anticipate that to be a full 61% retracement, but we should come back and retest some lows and create some sort of a sideways consolidation pattern. If there's indications over September, October that we are going into a full recession, economic recession on a global scale, Treasury bonds actually have the potential to rally even up towards 148, 150 to historic highs. and bring yields and the yield curve very, very thin. And that move, though, we don't anticipate to be occurring at this juncture. So at best, we would see a retest of these highs and consolidations down towards the 134, 135 area. Even short-term lows could come in even as low as the 132 zone on the downside. So we're sort of looking at the Treasury bond now in a far more neutral perspective. That was your Monday Futures Market Outlook. Thank you for joining me.